2 minutes longer? We want to get going?
Yeah, absolutely.
All right, so I'm going to open it up. My name is Jake Harris. I'm the co-chair for the Finance and Insurance Marshall Fire Task Force. I'm co-chairing with my associate Casey here, and we're going to be talking about banking options for the underinsured. So let me open it up by saying that the home builder associations are really the voice of the construction industry for both home and commercial building and remodeling. Our Metro Denver HBA members perform just around $5 billion annually in the Metro Denver area. That's an amazing accomplishment. Metro Denver has been the HBA has been in existence for over 80 years, and these members produce over 1 million homes and add millions and millions of square feet into commercial, retail, and industrial space. Metro Denver HBA is part of the largest NAHB association, National Association of Home Builders, and that NAHB is a federation representing over 140,000 companies and is somewhere in the neighborhood of 10 million people in the association. Now, specifically our association, the Metro Denver HBA, you can find at www.hbadenver.com or by calling 303-778-1400. I'll put this information in the chat. And if you're looking for the videos that we're recording tonight and the videos that have been recorded before for the Marshall Fire Task Force, look up in the top right-hand corner and you'll see them and you'll be able to find those. And please check out all of those. They're all great information. Tonight's presentation, again, hosted by the Finance Insurance Subcommittee. We present banking options for the underinsured, presented by Casey Bushnell of First Bank, my close friend, and moderated by me, Jake Harris of Build Wallet. Casey's a vice president of First Bank in the South Market. He started with the bank in early 2015. His experience in commercial and consumer lending. Prior to joining First Bank, Casey graduated University of Wyoming with a master's of business administration. Casey has lived in Littleton with his wife for the past 8 years. I'm really excited about this opportunity. I think it's going to be a great presentation to learn and really understand equity in a home. That's something that eludes a lot of people. And a lot of things, and another thing that we're going to bring up is the idea of what happens if the insurance payout is less than the cost of replacement. That seems to be a sticky conversation. So I'm really looking forward to our conversation. Ground rules for the conversation: if you have a specific conversation or a specific question that's relevant to everybody in the group, you can raise your hand. I'll call on you. We'll get that answered, and we'll interrupt, and that's fine. If you have something that's more specific, leave it till the end, and we'll do some Q&A. And then, of course, we'll make both of our contact information available if you have specific questions that we can answer offline. With that, Casey, I'll turn it over to you, and we're looking forward to the presentation, man.
All right, great. Thank you, Jake. I'm just going to screen share here. Give me just a second to hold up. All right, there. Can everyone see the presentation? Good. Thank you, Jake.
Good to go.
All right. So, I'm again, like Jake mentioned, my name is Casey Bushnell, and I can't speak on all of the different situations, and definitely not on behalf of all lenders, but I'm hopefully going to be able to just provide some very basic information on your situation to hopefully help you be able to understand it a little bit better. And we're going to kick through the slides here. Get the Zoom presentation out of the way. So, started right here, we've got the Construction Lending 101. Like Jake mentioned, ideally you have enough homeowners hazard insurance in place to cover the full cost of the rebuild. But especially in this environment where costs have increased and the cost of build have increased, not everyone has adequate insurance to fully cover the cost to rebuild the home. And even if you do think you have adequate funds to rebuild the full home, I recommend getting a lender involved and talking about a construction loan, going through your options, unless you're absolutely certain that you have enough funds to do the full rebuild with some contingency, some backup, because there's going to be overruns, there's going to be change orders. The issue with starting it without a lender is that once the build's underway, it's going to be significantly harder to get a construction loan secured by the home. So now moving on to not having adequate insurance. While that's not an ideal situation, it does not mean you're unable to rebuild your home. You only need to have enough equity available to then allow financing to bridge that gap between the insurance coverage and the amount needed for the build. So The slide here kind of goes over some of these sources of equity, but you're going to have the value of the land that's remaining after, even if you have a total loss of your home. And then there's going to be the insurance proceeds. The only thing they have to back out of those two values is going to be any existing liens that you owe against the property. But what's remaining is what's going to be the equity that you have available. So while the cost to build have increased, land values have gone up, and you've also been building equity. There's the equity that you put in when you purchased the property. And there's also, the payments that you're making that have been building equity over time. And so again, the cost to rebuild is greater than the insurance payout. You can utilize your equity to help finance the difference there. And lenders will take that into consideration, all of the existing equity, in relation to the total allowable costs. And the total allowable cost is going to be the cost to rebuild, the cost of the value in the land. Then the cost to rebuild is going to be the hard costs as well as the soft costs associated with the build. Hard costs are going to be like materials and labor that go into the full build. And then soft costs are going to be the ancillary costs, lender's fees, builder fees, architect fees, those kind of costs. In addition to that, you're always going to want to make sure that you have contingency. So if a lender's involved, they're likely going to ensure that there's going to be a contingency there. They'll also be considering the as complete value. So they're going to take your full cost to build along with the budget plans and specs for the build to get an as complete value, and those are going to be the determining factors. So right here at the bottom of this slide, there's a quick example of equity. So say that there is a $1 million cost to build, and 300,000 of that is going to be the land equity. That's the land value that you have. And the additional 700,000 above that, you're going to have 30% of equity into the project. And in most scenarios, that's going to be enough to leverage against that to finish the build. So the other possible scenario, of course, is that there's no equity available, or that there's not enough equity available in the property to allow for financing. And in that situation, like, while that is unfortunate, it's not impossible. You just have to find other sources of cash. And that's going to be in the list there. In addition to the insurance proceeds, if any, personal sources of cash, or you can look to leverage other assets, collateralize other assets into more financing. Being that that's my background, that's kind of what I always default to. So if you have any second homes or investment properties, you can utilize those, leverage that equity to get you the funds that you need to carry on with the build of the home that was lost. Slides here. All right, so this is going to be talking about like just the general process. So basically, since the new loan amount is likely going to be greater than your previous loan, especially if you're underinsured, as with any new loan, you're going to need to qualify for the debt, which will consist of providing the standard finances and application to a lender to determine pre-qualification. And then once pre-qualified, the typical next step would be to begin the process with the builder and obtain a final budget plan specifications for the build. And the presentation here lists those out. So the full budget is going to be, like I mentioned, the soft costs, the ancillary costs, the ones that don't actually go into building the home, but are a true cost to you. The hard costs, which are going to be the labor and materials that actually go into the build. The land, which we consider a cost because that's how your equity gets into the project. And then, of course, always recommend there's going to be a contingency as well. The specs or specifications is just going to be kind of like the details, the finishes of the build. So again, I've already mentioned the appraisal in pretty good detail. Oh, Jake, we've got a question.
Casey, I would love for you to clarify something, because I think that this is part of the confusion. Is that, can you go back one slide?
Yep. So
this is happening so fast, right? When, as a banker in this current position, and you and I have talked, and I know that you do have Marshall Fire clients that are buying services and buying and getting loans. When should somebody plan on engaging a banker? In what stage? And then how long should they allow in order to get through this? Because what I see happening very quickly, which is something you mentioned last time, which is they could get straight lead to the contractor, and then all of a sudden the contractor is going to start wanting deposits and they're going to want to start moving money. And then you could easily work yourself into that situation that's very dangerous, which is they're moving forward without you as the banker and getting themselves into trouble. So can you give us a quick idea as a time frame as to when this needs to happen and how long it takes?
Yeah, so based on my experience, it can be a little bit difficult, determining the cart and the horse in that scenario. I always recommend, obviously, before you start incurring costs, getting a lender involved. I think it's a good idea to have like a prelim conversation with a builder and just have a general idea of what your goal is going to cost you, what your home is going to cost to build. That way it'll give the lender a little bit of a target to aim at. But that's not necessarily needed. You can get the lender involved prior to that. And we could do a pre-qualification, just say, look, max loan amount, I can get you in, this range, or it'll be $1 million or 800,000, whatever we'll get you close to that max. It's more difficult to estimate all the things to get there, but we can get at least an idea of where they're comfortable, find out from the customer, like the monthly payments that they're comfortable servicing, and then back into it from there. And then go to the builder, engage them, get the budget going, at least an initial budget, and work through all that. And then make sure that, you've got your feet underneath you and you're confident that you're going to be able to go forward with the loan and the full process before you start incurring those costs for deposits and architect fees.
So, and that's a really good point, because I think that a lot of people, you talked about cart and horse, right? So if they go out and they tell the architect their dream house, right? They spend the time to describe the dream house. Then they take it out, they spend all the time and pay all the fees and do all the architectural renderings. Then they send it to the contractor and get the budget, and then come to you and realize that the dream house is outside of their reach. That can be problematic. So if I understand you correctly, the recommended path is start with a preliminary meeting with the banker, understand your sandbox, right? Your available window of financing, and then kind of piece everything into that. And I think for one of the challenges, and I'll speak for all contractors, we're not comfortable having financial conversations with our clients. It's very difficult to talk to the client and go, hey, by the way, have you met with the banker yet? Do you have a preliminary qualifying letter? Do you know your price points, right? It's very difficult. We just want to kind of get their vision, get their dream, and start the process, which we all know. But especially in this situation, when we have people that are not used to this process, we need to have the courage to be able to speak up and say, let's talk about finances, right? Like, before we get too far down this road, let's talk about finances, because all of us want to have a successful conclusion to this.
Yeah, definitely.
Fair? Okay. I think those are great points.
All right, so mentioning general contractor, good segue into this here. So I, again, can't speak on all banks, but what we like to do is we like to have an experienced GC involved, one that we have worked with in the past. And if we haven't, we're going to vet them. We're going to call on references and make sure that they are, experienced enough to complete the project on time, within budget. The main kind of concerns for both the homeowner as well as the lender. So that's why it's important to have a lender involved, is they're going to help you monitor the process. They're going to make sure that the house is built in accordance with the draws and that it's somewhat equitable along that path, so that the hard costs are getting drawn in accordance with the construction progress. So that's another reason to get a lender involved, even if you think you have enough. And of course, I already mentioned the appraisal, so we're going to move on here. So once we have that appraisal, that's going to give us the as complete value, which is determined by the budget plans and specs. We're going to have the total allowable costs for the build, so the all-in cost for the build, as well as the as complete value. And we're going to size the loan to the limiting factor that's going to be the lesser of those two. And there's some examples here. This is going to be different for every bank, and these even don't match ours for our Marshall Fire program. We have a special program for the Marshall Fire families. So, but for example, here we're going for the 85% of the total cost and the 80% of the appraised value. And we're going to kind of work into those to find out which ones are going to be the limiting factor. So a couple of just quick scenarios here. If the total costs are $750,000 and the appraised value is $800,000, the max loan amount is going to be limited by that cost, because that $637,500 is 85% of the total cost. and just under 80% of that appraised value. And then in example 2 here, it's going to be flipped. So we're going to be limited by the appraisal because the total costs are 1,000. The appraised value isn't as much ahead of that on a percentage basis. So we've got the maximum loan amount at 840, which is based on 80% of the appraised value. So it's always going to be whichever one is the limiting factor that the bank is going to lend into. So here I want to go through some of these common questions, just typical questions that we run into. Do I need to pay off my existing mortgage in order to obtain a new construction loan with First Bank? I always get that outside of the Marshall Fire, just construction questions in general. We don't allow for like a junior lien. So yes, the mortgage would need to be paid off in full, especially in the event of a total loss though. The notes here read that, you should get with your current lender, the current mortgage lender, to determine your options. Because again, if you know you have enough, it might be beneficial to work with that existing mortgage, leave it in place, and use the insurance proceeds to rebuild. The downside to paying it off right now is that in most cases, rates are higher for based on today's rates compared to prior recent years. And again, the main benefit is you'll get a lender involved that can make sure you have contingency, see the project through, and help you along in the process. The other question here is, if I own my land free and clear, do I have to bring any more money to the table? And the answer here is maybe. It depends, kind of the typical answer. The previous scenario with the 30%, in most cases, that would be enough equity in. But it depends. If you have, a $200,000 lot and you're way overbuilding and it doesn't provide enough equity in to meet that loan to value, loan to cost equity requirement, you might have to bring additional cash. And that's when you're going to have to tap into those other sources that we mentioned earlier. All right, and then here for a final question, just to kind of nail this point home. We've got, when should I apply for construction financing? I think I may need additional funds beyond my insurance proceeds. Jake, you've already alluded to this. We've kind of talked about it a lot, but definitely it's important. Can't stress it enough to do it early on in the process, and especially prior to breaking ground, starting construction. Because once you do that, once you get too far along in the process, it's going to be hard to obtain bank financing because you've done so much of it without the bank, and you've got, value in there that can't be lent into anymore. So on that note, that kind of ends my presentation for the part where I'm just talking. Are there any questions?
Well, Casey, I just want to take a second and really double down on this slide and this conversation, because I think that out of all of our conversations, out of all of our situations, I think this is the one that needs to really be brought to light and really put a spotlight on, specifically because I think that if somebody who has received an insurance payout and talks to a contractor and feels the pressure of time and wants to start things moving, right? The fire happened over a year ago, right? Like just over a year. They're really stressing about the time. I feel like they need to get something moving, and they have capital available for reconstruction. And so they start to move that towards the contractor, and you can actually get yourself in a lot of trouble if you move too far before engaging a lending partner, before engaging a banking partner on these projects. So just if there's one thing that I want to make painfully clear on this presentation, is just that it really comes into the fact of having that banking partner from the beginning, even if you don't think you necessarily need them, but you need to make plans accordingly, because retroactively bringing them into the equation, as you and I were speaking prior to Showtime, chances are, you said hard, it sounded like they were impossible.
Yeah, it's gonna be very difficult. We're gonna have to look for, in most cases, other equity. We're gonna look for another funding source. So we've seen people already, Marshall Fire families that have started, and then they get halfway through the process and they realize they've got a funding gap. They're gonna be 50,000, 100,000 short. And that's where it becomes very difficult to step in. Now, that doesn't mean that you cannot get started without the bank necessarily. You can get going, like talking about those the deposits for the builder, for the architect. You can get that stuff going, and we'll actually give you credit for that as like a prepay. Just make sure those are documented very well. You got the invoices, you got the proof of payment, and you'll get credit for that as equity into the deal, just like your land equity or any insurance proceeds or cash that you bring to the table. The main thing is that you do not want to start the actual physical construction without the lender.
Everybody agrees that that's nothing that you want to do, and so we need to have confidence in the construction world, having those uncomfortable conversations. But you might be saving your owner a great deal of grief if you're bringing this up ahead of time and say, hey, just so you know, I heard in an HBA conversation that I was listening to the other day, you really need to do this, and you can even refer them back to this document and let them know that you're not just you're not ringing the bell of concern for no reason, that this is actually something you might be doing to save them. So thank you for indulging me, but I really wanted to stress that point because I had no idea.
Yeah, so, is anyone else who's on the call right now? Do they have any questions?
Yeah, we're not going to let you go that easy. This is free access to Casey and his brain. He's got a lot of experience, a lot of opportunity, and he has Marshall Fire families under his care. So I want to see some good questions. So let's bring them on. Who's interested?
All right, guys. Well, I'm definitely put my contact information in the chat right now. So if you think of something later, you don't want to ask now, do not hesitate to reach out, and I'll get them help. If I'm not the person, of course, I'll get someone that knows the answer. Always happy to help.
Casey, it's my understanding that the actual fire families that are in the process of rebuild, I mean, we're still less than something like, 10-15% of the actual properties that were lost catastrophically. I mean, so this is still something that's going to be taking the next couple of years. Is your team seeing that? Is your team prepared for that? I mean, you're seeing a ramp up in that space?
I mean, we've definitely started out helping some families already. I know that the team, especially up there in Boulder, is running with quite a few of them right now, and we do expect the pace to pick up. Absolutely, and we're ready to help. Good.
You made mention of something that I want to bring up. You made mention of a fire family special. Can you talk about that for a second and maybe give us an idea of what you put together for the group through the HBA?
Yeah, definitely. So the First Bank is offering additional programs that started out just as Marshall Fire, but we actually adapted it to any federally declared disaster areas that we obviously in the communities that we serve. And it involves increased loan to value, longer rate lock periods, and reduced fees. So we have a traditional construction loan and a single close. We'll waive out of the bank fees or have a reduced fee, a reduced rate. And yeah, just general better terms. We're even offering 30-year fixed on our single close for non-jumbo, which is a new product for us. But yes, absolutely. I would just recommend, of course, if you're going to a lender, to go towards like a local lender, someone who's familiar with the situation and is aware. In the call that we had yesterday, we've already had some people that spoke up that ran into issues with some of the national lenders that were unfamiliar with the situation. So I would say whoever your lender is, local lender, go to them for help. And they'll be able to, I put together a full list of lenders for the Marshall Fire Task Force, and the list of lenders is all available on the HBA website. And a lot of them, the majority of them, have some sort of special program just for this cause. So definitely reach out, shop around, and just ask questions.
And that could be everything from a reduced rate, extended period of lock-in, different additional items that you could go ahead and do. So I thank you for your effort there, and I thank you for communicating and collaborating with your other fellow bankers and other fellow financiers in order to get that list together. So that list again is on the HBAdenver.com, top right hand corner. Go to the Marshall Fire Task Force and you can do that. Now Nathan has a great question. Is there a way to get a loan for a standing home who has a funding gap? Now I'm probably going to need to get some additional information from Nathan as to, this is a standing home, so this is an existing property? Nathan, can you join us?
Yeah, I'm here.
There you are. Thanks.
Yes, for an existing property, damage in the Marshall Fire, but still standing. Everything had to be gutted though, down to the bone.
So yes, I would think that that's going to be doable. So that's not something that we addressed in the presentation, but if there is damage but not total loss, the thing that would be difficult, and that's just simply because I don't have experience with it, is the appraisal and how they're gonna appraise that existing value and equity in. But yes, that should be doable. I would just, again, strongly recommend you don't kick off work just because you've already got, the frame up and you want to start going rough in or whatever. I would recommend getting the lender involved ASAP to go over your particular situation, but that should be doable.
And Nathan, I'll stress again what Casey and his team have done. I mean, find local resources. So there, you qualify as a special case in the sense that there are specials and special advantages of being in the Marshall. I know it's not an advantage situation, but again, if you're take advantage of it. The opportunity is that the local builders and the local banks are actually putting together and have a list of specials. And if you have any problem any problem finding that, or if anyone has any problem finding that, contact Casey or myself. Casey put it together, reached out to his other banking partners, and did a very selfless thing and found out all the great resources that the HBA banking associates were putting together. And we have that list and we want to make it available to you. So take advantage of those resources. You can get deeper discounts, greater LTVs, greater lock times, all things that are very advantageous when you're in a rebuild situation, because that community cares, and the rebuild it affected a lot of our own members. So take advantage of those, please. Awesome. Jamie, we had a great conversation in the beginning. I refuse to believe there's no questions out of you. What else you got?
I'm just taking it all in.
Good information. Anything popping to mind?
No, really good information. Yeah, I think this is exactly what we're looking for. I appreciate all the resources.
No, I think, and like we talked about earlier, I mean, having the confidence to have a conversation with an owner early on in the project and say, hey, do you have your bank in line? And they go, no, I got the insurance payout, and go, stop. We need to have a conversation. I'm trying to help you, right? I'm not trying to get into your finances. I'm trying to help you, because if you go too far without a bank loan and you find there's a gap, it will be very hard to go back in retroactively. And I think that's something that talking to Casey over this period, I had no idea as a builder, and I would have completely blown by, and been so excited to start the job, get the deposit, start moving, gotten all the way through rough in mechanical, electrical, plumbing, gotten to finishes, been putting in glass doors, only to have the client tell me they ran out of money. And that is actually a case of what happened in the Sonoma Valley fires, where builders and their owners didn't understand the finances around insurance and got themselves in a lot of trouble. And the owners just threw their hands up. They said, hey, look, I don't have any money. I don't have any more money. The insurance money's gone. I spent it on rent. I spent it on food. I spent it on the apartment. There's nothing left. And as builders, we can't be in that position. So again, it's a combination. And as we spoke about yesterday, it's a combination. It's a journey. You're on this journey together, builder and owner. Make sure you have a financial plan. That's kind of your roadmap to get to the end. So Casey, any final thoughts, any other pearls of wisdom to drop on us? That was great.
I think that's all I have, of course, unless anyone has any other questions. So happy to answer.
Dominic or Dave, calling out anything? Last final thoughts? Nathan already had a good one. If you have another one? No? All right. So these will be recorded. These will be posted online at the HBAdenver.com website, top right-hand corner. Look and you'll find those recordings. And again, if you have any questions, HBA Denver office, 303-778-1400. 303-778-1400. Jake Harris, Casey Bushnell, it's been our pleasure to serve you tonight, and we wish you guys a great night.